morning and welcome to BloombergQuint, India's first digital live streaming business news service. I'm Neeraj Shah and you're watching Indian Open. Let's go straight to the headlines. A sell-off that wiped out the year's gains from global equities continues in Asia today as authorities around the world struggle to keep the coronavirus from spreading. US President Donald Trump will meet Prime Minister Narendra Modi for bilateral talks later today. Violence erupted in Delhi as pro and anti-CA protesters clashed. Prohibitory orders have been issued in the northeast of the capital. JSW Steel's acquisition of Bhushan Power runs into yet another legal hurdle. A former chairman of the stressed company challenges the deal in the Supreme Court. Well, let's take a look at the trade setup for the day. And frankly, if you just look at what the world markets did or the US markets did in trade yesterday, you would have believed that all hell will break loose in the session today because they cracked quite viciously. And with these moves, the Dow Jones erased the gains for the year 2020. Frankly, it was seen in the way the volume and the price action was there in the US markets, as also in the way some of the yields, etc., reacted in the session yesterday. So it didn't look all that great for the world markets by and large. Keep in mind that the US 10-year Treasury yield has sunk to its lowest level since maybe 2016 or thereabout, but fallen to near September lows. And this shows how there is a penchant for safe assets like treasuries as opposed to the equity markets in the current term. Even if equities haven't sold off too much, there's just this penchant for bond markets, and treasury yields are falling in quite a bit. And there is a big divergence between what the commodity prices are doing and what the world markets are doing as well. And therefore, there's a lot of people who are saying that why is it that equities may not return to what yields or commodities are doing? And that's the chart which shows the dichotomy. Can that correct is the question mark. Now, as I said, if you just looked at what the US markets did yesterday, you would feel that all hell will break loose today. Surprise, surprise, Asia is not necessarily showing the same kind of a move down. Yes, select indices are, but because of the Dow futures being in the green by about 200 odd points, the rest of the Asian pack is, or some of the Asian pack is a lot more well behaved today. Hang Seng, as you see, is marginally in the green. And the going, therefore, is looking pretty okay for the rest of the Asian pack. Now, frankly, if you just look at what our markets did in trade yesterday as well, it showed signs and palpable signs of a lot of pressure because the statistics were very bad. The BSE stocks eroded market cap of nearly 3.1 lakh crore. It was the first time in nearly 5 years that all the Nifty 50 stocks, each of the Nifty 50 stocks were in the red, and the budget day low of 11,633 now becomes a really crucial support if indeed the trade worsens. But will trade worsen is the question. Well, the SGX Nifty seems to suggest that it will not be the case because we are likely to start off about 0.5% in the green. So before we get to specific stocks, I think it's important to get an assessment of how does one approach trade in the near term. Global equities and other asset classes. Cliff Tan, East Asian Head of Global Market Research at MUFG Bank, joins us right now. Cliff, good having you. Thanks so much for joining in. It's very topsy-turvy because the US futures are in the green and therefore Asia is not reacting as badly as one would have thought. What is your sense? How does the near term shape up?
Well, I think today will probably be some sort of a technical rebound. You can see it in the currency markets. You can see it, as you mentioned, in the equity futures. Now, what the rebound is based off of, besides price action, is very difficult to see. We felt for some time, and we still feel, that the markets are still not fully appreciating the full force of this disease outbreak on global aggregate demand. I think what they're starting to price in the last couple of days, last week and then also, of course, yesterday, is that there could be an aggregate demand shock hit not only to China that ripples out across the world, but it could, hit other places of the world and ripple back into China and other places. So people were not counting on that. I think they were extremely short-sighted because I don't think it would have taken a lot of imagination to, based on what we've known of past epidemics, to expect to see some of what we're seeing now. I would say that certainly there's a premium for calmness right now. I mean, we are still expecting this episode to eventually be over, say, by late April or early May. But, that's a hypothesis that we need to test every day. And in particular, I would say that the rebound today is a statement that the more industrial countries will have greater success at containing the spread of this disease than China has had. I hope so. I hope they're right. But I think right now we don't know enough about the disease to make that kind of conclusion yet.
Okay, fair point. Cliff, the one argument being made is that, because of the advent of summer, the disease hopefully will get contained and all of that, and therefore the optimist is saying that the economic impact, while unpredictable, would be there in the current quarter, will not necessarily last with the same impact in the quarters to come, and therefore because markets look at the future, they will discount the present very, very quickly. Is that a reasonable argument, or is the economic impact so difficult to quantify right now that markets are underpricing it?
I think it's a reasonable argument if you could have certainty about the boundaries of where the disease is going to hit. I think what we're seeing right now in Europe, and in some of the Middle Eastern countries, is that we're seeing the same kind of, this type of shock. The main effect is to keep people from meeting face to face, and that's a shock for everybody, no matter where you are in the supply chain. And so, if this is the kind of reaction, the kind of natural reaction that you would get to an outbreak like this, we're going to have aggregate demand weaker in Europe, in the Middle East. And as I said, I think what people were counting on was that, well, China will get over it, and then it'll start producing again, and the supply chain will get back into traction. But what if, the places that you sell your goods to also have aggregate demand down shocks? That's not something that I think people have fully priced in yet.
In which case, Cliff, my final question. We've seen some of the commodity prices across the world come off quite rapidly. Do you reckon they'll stay lower? Crude, base metals, the likes?
I think logically they should stay lower. They were actually, as you may know, in the last couple of weeks, kind of making a bit of a recovery from the first shock. But I think that recovery is going to be aborted based on what's happened so far.
Abort, yes, indeed. Certainly seems to be in the way the price action is right now. Cliff Tan, take a moment to thank you for joining in today and giving us a sense of how you feel that things could shape up. Bit of uncertainty.
Sure, always happy to be here.
Yep, thank you, Cliff. Well, and I think he's put it well because it's unpredictable, and that's what we've been saying now for the last 2 or 3 sessions on the podcast, on the show as well, that it is unpredictable and it's difficult to price in what the unpredictable can do. Nevertheless, let's talk about specific names as well. We've already established that we may start off in the positive. The question is, can we stay there, and what could specific stocks do? Will we stay there? Difficult to say. But what are specific stocks that might react? It's not as news heavy a day as yesterday, but still 3 or 4 names that are important to my mind. HUL, the board has approved formation of a new 100% owned subsidiary. Macquarie believes that the new subsidiary can potentially have tax benefits, and therefore this should augur well for HUL. Let's wait and watch how this one does in the session today. Indian Hotels in the analyst meets reasserted that it remains on track to achieve the targets outlined in Vision 2022. The margin improvement remains strong and is on target. Remember, they had mentioned about a 25% pre-Ind AS adjustment margin outlook, and they've reiterated all of that. So positive statements coming in. Let's wait and watch if on a day like this Indian Hotels can react. TVS Motors, the company said that the coronavirus outbreak impacted February production and will see a 10% drop in planned February production. This is not unplanned, but planned February production may take a hit. So anyways, demand is faltering and they might see a production hit as well. Maybe this one will have a negative reaction. 2 F&O inclusions, or 3 actually. Info Edge, HDFC Life and Bandhan Bank will be a part of the F&O from the March series. At least HDFC Life and Bandhan Bank are very well traded stocks, and therefore welcome inclusions, I would reckon. Lastly, Bharti Infratel, CLSA has cut the target to 200 from 230. They have maintained the sell. The stock has been on a roller coaster ride. CLSA is a bit more bearish than maybe some of the others on Bharti Infratel. Let's see if this has a further drop in the session today or no. However, let's tell you what's lined up on First Word today. The top editorial stories that we want to bring to you. Donald Trump and Narendra Modi sit down on the negotiating table today. Unnikrishnan tells us what to expect. There has been a spurt in bond issuances in India. Advait tells us why. Shefali then tells us why Castrol India has managed to narrow the gap with Gulf oil over the last year, even though the last 5 years Gulf oil has been at the center stage. And then Darshan takes us through the worst and the best margin performers in the third quarter. Donald Trump's arrived in Delhi last evening. While yesterday was all about festivities and a visit to the iconic Taj Mahal, he has a lot on his plate today before leaving for the US. Unnikrishnan of Bloomberg News has the details.
Good morning. So today is the second day of President Trump's visit to India. Yesterday was a visit which marked a lot of festivities. He made this rousing speech at the Motera Stadium in Ahmedabad. About 100,000 people turned up at the stadium to listen to Prime Minister Narendra Modi and President Trump, where he underlined the importance of growing strategic ties between the two nations. And that would be exhibited today when the bilateral part of the official part of the visit kicks off. President Trump would start the day with a ceremonial reception, followed by paying respects to the father of the nation at Rajghat this morning. And then subsequently, in the afternoon part, he will be holding bilateral talks with his counterpart, Prime Minister Narendra Modi. On the agenda, there's a host of agreements lined up, prominently a $3 billion deal for supply of military hardware, which includes 26 naval helicopters and other military equipment. Also, another agreement for closer energy ties. Later on, President Trump would address a business delegation. There's a meet and greet at the embassy in New Delhi, and thereafter he would be attending a banquet hosted by the president, and he would then head off to the United States later in the day. So it's going to be an action-packed day today, and hopefully we'll see a host of agreements being signed in the afternoon when the bilateral talks happen.
All right, we'll be watching our first soundbites around this, arguably the biggest state visit in the year thus far, arguably for the year at large. Okay, let's move on. The RBI's long-term repo operation prompted a lot of companies to issue bonds as yields fell as soon as the RBI governor made the announcement. Advait is here with some details around this as well. Advait, good morning. What do you have for us?
Good morning, Meeraj. So on the 7th of February this month at its monetary policy meeting, the RBI had announced that it would conduct 1 year and 3 year long-term repo operations. Essentially what this means is a bank can avail finance up to rupees 1 lakh crore for a longer term, so 1 year or 3 year at the current rate. So regardless of what the repo rate moves up over the next course of the next 1 year or 3 years, the banks have funding at this rate during these auctions that the RBI has conducted. So far, it's conducted 2 auctions. Last week, on the 17th of February, it infused 25,000 crores. Yesterday, it infused another 25,000 crores through these options. Essentially, the bond market saw this as a good move from the RBI from its operation to a similar strategy to kind of manage bond yields. Essentially, the RBI, by unloading this liquidity onto the market, is trying to push the yields down, especially for the 1 year, 3 year, and 5 year buckets. So what happens is the yields move down, which become more attractive for borrowers to come into the market. So on the 7th of February, the RBI announced this LTRO facility, and the following week, bond markets issuances suddenly skyrocket. So between the week the RBI announced and last week, totally about 64,000 crores worth of bonds were issued, compared to about 24,000 crores last year. But last year, you have to understand it's post-ILFS, so there's a base effect issue there. Now, the majority of issues have taken place in the week before the first auction, which means the market had front-ended it. And last week were 2 public holidays, so we saw out of the 15 local bond issuances, 13 of them took place on Monday, the day of the auction itself. So what bond investors and experts say that is that the LTRO has helped push yields down, make it more attractive for these bond investors to buy some of the known names. And we've seen a host of companies from NBFCs, industrial companies, as well as larger institutions, corporate groups also buying into issuing bonds over the last 2 weeks. But ultimately, whether the second round effects of the LTRO operations, which is to boost credit, will actually play out, there's still some time to see that take place.
Are people saying that there could be more, or was this a tactical move because of this announcement and the dip that we saw in the yields? Because I do remember that from 6.50 on the day of the policy, The yields went down to almost 6.34 before bouncing back a bit. So was this tactical to bunch it up, or or are people expecting, maybe not in the same vein, but more bond issuances in the coming weeks?
I think, you know, if you've seen how bond markets have played out, regardless of what all the announcements have taken place over the past 3 months from a policy perspective. In December, you had Operation Twist, then the budget, the government had announced the hike in the FPI limits. Now there's the LTRO move. The bond markets tend to factor in this earlier than the actual date of when these policy announcements take place. So it seems like these bonds are there to be issued. They're in the pipeline, and so these events happen to be good triggers for. So as soon as the yields fall, might as well issue then wait for them to rise up again on.
So not quite certainty about whether the same vein would continue or no, but a large portion.
It's unknown because the LTRO operations are total for 1 lakh crore.
Yeah.
And so far 50,000 crores is already completed. So when I asked bond experts this, like, once the auctions run out, do you see yields jumping back up? They said hopefully it doesn't, because at least the 1, 3, 5 year buckets show that the risk aversion that the market had is reversing certainly, and also the companies are also being priced at a much reasonable rate compared to last year. So the credit risk aversion and those factors are also taking place, playing out in the minds of investors.
Okay. Advait, thanks so much for putting that into perspective. So corporate bond insurance has picked up in the last 2 weeks, preceding the actual LTRO operations done by the Reserve Bank of India as well. 60,000 crores, if I got the number correct, compared to 24,000 crores or thereabouts in the whole of last year. That gives you the extent. I mean, yes, there's a base effect, but it gives you the sense of how quickly corporate India jumped onto the bandwagon. Well, interesting story. Okay, let's move on. Some comparisons between a couple of couple of listed names. Castrol India's dogged focus on retail has just started paying off dividend, because the lubricant maker, which was lagging behind its listed peer Gulf Oil, has managed, I mean, at least for the last 5 years, has managed to turn the tables slightly in 2019. Shefali is here for more on the details. Shefali will get to what the second player, which is Gulf Oil, did over the last 5 years with Castrol as well. But first, the immediate thing, 2019 has shown a slightly different picture.
Well, yes, to some extent the auto industry slowdown has had a role to play in that. So why basically this difference has come in last 1 year? So it's important to look at the volume picture. I've taken last 6 to 7 quarters. So look at the volume growth for both these. For Gulf Oil, let's say in July to September 2018, it was doing something around 30% growth. Then in Q3 of FY19 as well, it was doing 34%. So from those 30% growth levels in volumes, it fell down to single digits in next 2 quarters, and from those single digits it came down to minus a negative growth in next 2 quarters. And for Castrol also there was a fall over last few quarters, but it wasn't much. So all the players were impacted because of the auto industry slowdown, but the fall in Gulf Oil was much steeper, and the reason for that was that Gulf Oil has a larger focus on the B2B space, that is the lubricants they manufacture which go to the factories, which they also term as factory fills. So that component is a little higher, whereas Castrol on the other hand is more retail focused. So you look at the breakup for Castrol, automotive segment is 90%, non-automotive is 10%, Gulf Oil is 60 and 40. So because of that higher 40% component, that component got impacted. Every quarter you speak to them, last 2-3 quarters they've said their factory fill volumes have been impacted because of the auto industry slowdown. So that because of that their overall volume picture has gone for a toss this time. So that is the picture over last 1.5 years.
Last 1.5 years. But if you look at the 5-year story, Shefali, it's completely different, because the number 2 player has given the number 1 player a serious run for its money.
Yes, absolutely. In fact, it's a classic example of volume versus margin story. So Gulf Oil being the number 2, obviously they've had a lesser base effect of volumes, so they've grown at a faster pace. Whereas for Castrol, the focus has been very clear. They've focused on the margins. So let's do this comparison of volumes and margins. So for Gulf Oil, the average, the volume growth over 2015 to 19 period has been 9.68%, whereas for Castrol it has been 3%. And if if you look at the margins, Gulf Oil has maintained margins of around 18%. That's the average figure for last 5 years. And for Castrol, it's 28.6%. So Castrol has had very clear focus of maintaining the margins between 27 to 30%. And whereas for Gulf Oil, the focus has been very clear to grow the volumes and capture the market and increase the market share. So that because of that, the street was rewarding them. And even if you look at the stock price performance, the Gulf Oil over last 5 years has given much higher returns of around 55% over last 5 years, whereas Castrol, which has degrown the share price by around 35%. And so that's what has happened between their volumes and margins focus. Going forward now, what are these companies saying? Gulf Oil is saying that they will continue to grow 3 to 4 times the industry, which they have been doing over actually not just last 5 years, but over last decade. So they plan to continue doing that, whereas Castrol is saying that they will continue to focus on the retail segment, which they also call bazaar segment in their terminology. And also they see a revival in the auto segment going forward. That is a commentary coming in from Gulf Oil management that in next few quarters we will see a pickup. Even that factory fill segment will start looking up from here on. So they're optimistic about that, but they don't have any expansion plans right now because they're done with that largely, whereas Castrol is still planning to invest around 140 crores on the capacity, and they're looking to boost volumes. So that is important commentary from Castrol also coming in last few quarters, that going forward they plan to balance the two, volumes and margins. So it'll be interesting to see how it plays out, but the analyst fraternity clearly seems to be still favored in when it comes to Gulf Oil. So you look at the valuations, Gulf Oil is trading at FY21 PE of 14.96, Castrol about 16.76. So Gulf Oil still slightly cheaper in terms of absolute valuations. And if we look at the number of analysts tracking it, Castrol 11, Gulf Oil 9, and 82% analysts have a buy rating on Castrol and about 89% on Gulf Oil. Nobody has a sell rating on Gulf Oil, whereas 9% are still recommending a sell rating on Castrol, and 9% have a hold rating on Castrol, and about 11% have a hold rating on Gulf Oil. So slightly skewed in favor of Gulf Oil still.
Well, let's see if the last 5 years are any indication, and if the next 5 years can be the same. It will be good times for Gulf Oil. Shifa, interesting perspective. Thanks so much for comparing the two and bringing us that analysis. So, okay, well, earnings may be over, but the third quarter earnings season throws up some very interesting data. Now, we've been doing this data crunching for the last few days, and while we've spoken enough about the large corporate results, let's talk about the best and the worst operational performances in the broader markets. Darshan has the list. Darshan, good morning.
Good morning. So basically what we've done is that companies in market cap in excess of 1,000 crores, that's the selection criteria. And we've excluded, banks, financial institution, because they don't really look at operational margins. They will look at NIMs. So we've come out, that's the selection criteria. The top 5 companies that we actually spoke about. In terms of, let's talk about the companies which saw the maximum change in margins, and this is in terms of basis points. So Godrej Property, Electra Green Tech, which is basically into e-vehicles, MCX, Midhani and Shilpa Medicare, all of them saw a maximum change in open interest. Some of them were negative last time around. This time they've come into positive. So we're looking at the absolute change in terms of basis points for the margins. Now, let's take a look at what aided some of them. Godrej Properties obviously came out with very strong set of numbers. Fall in inventory cost. They've been getting out of their inventory, and that is something that aided Godrej Properties significantly, and that was one of the reasons why the numbers were extremely strong this time around. Electra Green Tech, a very small company dealing in e-vehicles, and one of the key reasons why the margins expanded for the company was basically the fall in raw material costs. So that helped the company significantly. MCX was a big surprise, came out with very strong set of numbers and has rallied significantly. The current average daily commodity trading volumes has been trading at record highs. So there has been a shift, and one of the key reasons is also how gold has panned out. So MCX India has done extremely well operationally. The other two is Midhani, Mishra Dhatu. Better order book this time around. Raw material costs were lower, and that helped the company come out with margins of almost 1,600 basis points, so 16 percentage point increase in terms of margins. And finally, Shilpa Medicare came out with strong set of numbers. Their revenue, mainly the top line, grew significantly from the formulation business. The API business also did extremely well, and they were able to reduce their costs significantly, and that is how their margins also increased by almost 16 percentage points.
Okay, so Darshan, what about the companies that saw the biggest margin contraction?
So I think the stars of the last 2 years, HEG and Graphite, have finally come back. I think the cycle has turned big time for them. So Graphite was almost 134 percentage points. So from a positive, it's almost into the negative. HEG also big drop in as far as their margins is concerned. And basically, realizations across the board have declined, not only for them but global players that are in the graphite electrode, and electrode prices have dropped significantly. So they have come back to the mean. And that's why the high base also impacted, the numbers for both these companies. Suzlon, I don't think anything is working for them significantly. Raw material costs were higher. They changed the revenue mix. So they had a lot of provision. All of them hurt Suzlon this time around. Mahindra Life, volumes were much lower this time around. Employee cost was higher, and the operating leverage probably didn't kick in for the company this time around, and that is why it was down. And finally, Adani Green was the last one. We saw a trip in margin. They changed the accounting standard, and there was a high rise in higher other expenses, which impacted the margins for the company.
Okay, and a story around this on our website as well. Darshan, thanks so much for putting that into perspective. So top 5 performers and top 5 losers as far as the margin performance goes, and that's all that we have on First Word today, but lots more lined up on Indian Open. Chakri Lokpriya joins us to talk about what are the companies that he's watching out for while the coronavirus unfolds, and Ramesh Kumar Dua of Relaxo will speak about how the footwear maker is weathering the consumption slowdown. But after this break, a full tilt towards the day's trade.